So this is Stephen from Share Navigator. We're going to talk about the bull put spread strategy. It's a credit spread, and we're going to use a real example with SPY in a few minutes. So just very briefly, is it a bullish or a bearish strategy? It's mildly bullish. The reason we say it's mildly bullish is that if you were more bullish, you'd simply buy the stock, or you might buy a call option. It's a credit spread. This means that you get paid upfront in advance to place this particular trade. So how do you construct one of these bull put spreads? Well, there's two trades. The first part of the trade is you sell a put option at a strike price which is out of the money. So out of the money for puts is when the strike price is below the current share price. So in essence, the first part of this trade is we're ensuring the value of somebody else's shares at a much cheaper price, and we're getting paid a premium for doing so. Then the second part of the trade, this is where we're buying a put option. So we're actually now buying insurance as the second part of the trade, just in case the share price tanks. And again, we use a strike price which is below the first trade strike price. And that's our little bit of insurance underneath it. This trade is normally placed as a combination trade. So we're going to do this for real now on SPY. So we're going to place a bull put spread on SPY. You're looking at the 1 year chart here, and you can see back almost 52 weeks ago the low was 182.20, and then more recently we had the whole Chinese volatility issue and the big sell-off there very quickly, then a recovery, and it's kind of hovering between 195 and 196 at the moment. Having a look at implied volatility, you can see it's withdrawing from its recent spike, but it's still kind of relatively high relative to where it has been in the last 6 months, so there's still opportunity here. So what we're going to do is actually place a bull put spread at the 180-175 strike. So we'll explain later on in the presentation what this all means, but we're just going to place the trade now. So we're going to click here now on our option trader from our trader workstation platform. Some great tools here. Even some of the more experienced guys listening to this, if you log into the latest version of trader workstation, you're going to see some great stuff in here. So we're going to click on give us the option change for SPY. Now I've already pre-populated this looking for the October 16th expiry, and I've set up a number of strikes here. So we're dealing with the puts here on the right hand side. But a new feature on this, you can see if we click on strategy builder here, we can actually build our strategy from here. So the first part of the bull put spread is we're going to sell the 180 put, and you can see that's automatically populated up here in the strategy builder. And what we want basically to happen here is the share price of SPY to finish above 180. Now the second part of the trade is just in case this whole thing breaks down and does fall down, we want to limit our risk on this, so we're going to buy the 175 puts also. So this is a combination trade. It's actually telling you here it's a bull put spread. It's giving you an idea of what the profit and loss situation, your risk is limited and so is your profit. Now I'm just looking here at the quotes. The quotes here, if I was to sell this, is 72 cents, and then to buy this one is 44 cents. So that's a net 28 cents in credit I'm going to receive. I'm going to try for 29 and haggle with the market. So I'm going to do 5 contracts here, but you may have a smaller account, may want to only do 2 or 3. So I'm going to do minus 0.29, and I'm going to click on then return, and I'm going to click on transmit. Now look what happens here. It's telling you what you're doing here in the combo, okay? But there's a little button here I want to draw to your attention. It's saying performance profile, and I'm going to bring this in and show you what it means. It's actually telling you your probabilities of success here. It's saying here your probability of success is 96%. On a per contract basis, your maximum return is $27. And your maximum loss is 473, but they're saying you've only got a 1.1% chance of that event happening. So for this particular trade, we're happy to take on this particular risk here because it's such a high chance of winning. So we're going to click on override and transmit. So that order has now gone into the system. It may not get filled straight away. We may haggle that back down to 27 later on. We'll just leave it as is. So now we're looking at the profit and loss table for our SPY bull put spread. Very important to do this, guys. So first part of the trade was the SPY. We sold the put for the October 16th expiry at the 180 strike and we received in 67 cents. What does that mean? Basically, we're insuring the value of SPY to the value of 180. The share price drops below that, we're committed to buying it at that price. But the second part of the trade is us buying a bit of insurance for ourselves. So we bought the $175 put underneath that. And basically what that means is we now have the right to put the shares back to the market at 175. So our risk is totally limited in this situation. And we had to pay out 40 cents in premium for that. So the net differential between the two there is 27 cents. That's a credit we received upfront in advance for placing this trade. At the time of placing this trade, the share price was at 197.22. So what we do then is we come into our what if scenarios and we say, okay, well, let's imagine now it's the 16th of October and the share price of SPY is at 170. What does that mean for us? Well, we put in the information we know. We know that we received in 67 cents in premium for selling the $180 puts. So that never changes. No matter what the share price is at, we've received that in. The second part is what it costs us to actually buy a bit of insurance underneath it, and that's exactly the same across the board at 40 cents. We put in a minus 0.4 because it cost us. So now we get to the 16th of October. The share price is at 170. What does that mean in terms of value of our $180 put? Well, if you think about it, a put option allows somebody to put the shares back to the market at 180. Now, if the share price is trading at 170, there has to be at least $10 of value in that particular put option. Now, it's minus 10 for us because we sold that put option. We don't own it. So in essence, for us to buy ourselves back out of that contract, it would cost us $10. At 172, it's $8 and so on and so forth, right till we get to 180. Now, there's no value in these options at 180. The reason being that if you think about it, at 182, for example, if the shares are trading at 182, why would somebody put the shares back to the market at 180 when they put them back to them at 182? Then we also have a long put underneath that. And the value of the long put on the 16th of October, if the share price is at 170, is 5. Because again, if, for example, we had to buy the shares at 180 and the share price is trading at 170, we have this put option contract that allows us to put those shares back to the market at 175. So that has to be worth at least $5 in value. At 172, it's worth 3. At 174, it's worth 1. So all we do then is just add up these four columns to get our profit and loss per share. And as you can see, it's very similar to our trade analyst that we just did there. So the worst we can do is lose 473 in this trade, and the best we're going to do is make 27 cents. And you're kind of saying, well, why would we do that? And the answer here is, I'm going to bring it straight down here, the probability of success is so high. We're forecast to make about 96% profit in this particular trade, no matter, so the chances of us losing here are very, very slim. In fact, we've only a 1% chance of losing all of our money here. There's a 3% of us having a slight loss and only a 1% of losing the max loss here. So our return on investment is about 6% on this particular transaction here. So, for a 96% chance in less than a month, that's pretty good. And the best part of this trade is our leeway to fall. So the share price could actually fall $17.49, which is 8.87% before we start losing money. Now, on average, the S&P 500 actually only moves about 4% in a month. So for it to move 8 or 9% is a lot. That's why our probability is so high. So we've given ourselves a lot of advantages here. Our max loss is 473. Our break even is once the share price trades above 179.73. And our max profit potential is 27 cents. Okay, we're going to go through a further presentation on this in a PowerPoint to explain the bull put spread in greater detail. Okay, so the share price of SPY was trading at 197.22. We placed a $180, $175 October 16th expiry bull put spread. So first trade was we sold the $180 put and received 67 cents per share. So we received in 67 cents per share for ensuring the value of SPY to the value of 180. As you can see, that's well below where it's currently trading. And then the second part of the trade is we bought some insurance at the 175 level and paid out 40 cents per share. And the reason we did that is to reduce our risk in this particular trade. So our net credit is the difference between 67 and 40, which was 27 cents or $27 per contract. And the reason is $27 per contract, that in the options market, one contract controls 100 shares of stock. So what's our risk in this trade? Well, the risk is limited, and it's limited to the difference between the strike prices minus the credit received. So for our SPY trade, the two strike prices were 180 and 175. The difference between those is $5. Our net credit received was 27 cents. So our risk is 5 minus 27, which is 473 per share, or $473 per contract. So what's our maximum profit? Well, the max profit is the net premium received. And for this particular trade, it's $27. And we get that if the share price of SPY finishes above 180. So you have to be asking yourself the question now, why on earth would I risk 473 just to make 27 cents? And the answer is because your break even is so far below where the shares are currently trading at. For our SPY trade, the break even is equal to our short strike, which was 180, minus the premium received, which was 27 cents. So our break even is 179.73. So once the shares of SPY stay above that level, we're going to be making profit. So remember, it's actually trading at 197 at the moment. So that would mean the share price would actually have to drop nearly 9% in the next 4 weeks in order for us to start losing money in this trade. And that's why we're making a small amount and risking a larger amount. It's because our probability of winning is so much higher. So our leeway to the downside, how you calculate that is simply take the current share price, take away your break even, and that gives you 17.49. So the share price would have to fall 17.49, and in percentage terms that's 8.9%. So the shares would have to fall 8.9% before you start to lose. So our probability of success, as you've seen with the real trade, was 96%. So the higher you want in terms of probability of winning, the less you're going to make. But I'd much rather have a higher probability of winning than have a lower probability of winning for this particular type of a trade. So just in terms of picking the strikes, if you're more bullish than we are, you would actually pick strikes that are in the money. That is where the share price is below the current strike prices. We were kind of mildly bullish on this trade, so we went with both puts out of the money. I like doing that for this bull put spread. That's my particular thing that I like doing. I like going out of the money on the strikes. But if you're more bullish, you could change those up if you wanted. Managing the trade. So let's imagine now you wanted to close this trade early. You'd simply buy back the short put, and then you could sell the long put. You can also close these out as a combination trade. It's very easy to do. But normally you would leave a trade like this till expiry. If the share price is above the short strike, you do absolutely nothing. Both option contracts will expire absolutely worthless, and you'll make your full profit. If, however, the share price is trading below the short put, then you're going to need to buy back that put option or roll it out, and then you'll sell your long call as well, or your long put option as well, if there's premium in it. Okay, if you want to learn more about these option strategies, why not try our mentoring service? Call us or send us an email. We'd be delighted to help. Thanks and bye for now.